Hey, very good afternoon, colleagues, friends, ladies and gentlemen, joining this session. I hope you're all keeping well and keeping safe. I hope you have had yourselves a very lovely start to the week and hope you had a very wonderful Easter holiday. Now, this afternoon, we welcome you once again for another exceptional session. And this afternoon, we'll be discussing fintech, the growth of fintech in the East African region. But as you settle in, please feel right at home. Share a link with a friend or colleague who you feel needs to be a part of this conversation and tell them that our session has started. We are streaming live on YouTube and we are also live right here on our Zoom platform. And this afternoon, friends, the conversation on fintech has been ongoing. And as a region, we are witnessing the growth of fintech, which is just beyond a growth, but you could look at it as a restructuring of how finance works in the confines of our region. So if you look at the growth of this in a very short time, you've seen mobile money services moving from convenience to infrastructure to what it is today. So today, it sits at the center of all payments, credit savings, and increasingly, we're seeing cross-border value transfer. Also, at the same time, around it, a much wider ecosystem is forming, which is digital lenders, payment platforms, virtual assets, and a new form of financial intermediation that did not exist just a decade ago. As you all know it, the law has not had the luxury of slowing down and adapting to this shift. And it's been asked in real time to define the boundaries of something that is constantly evolving, and that is where it sits today. And because of the real tension on whether fintech will actually grow, like we already know it is growing, the question is what kind of legal and architectural regulatory architecture will it hold? Will it be one that protects users without shutting down innovation? Or will it be one that builds trust without creating friction? And shall we at one point see that we have a fintech architecture that allows the region to move together rather than in fragments? And that's why this conversation that we're having this afternoon really matters. This afternoon, we are going to look at how fintech is actually being built and financed, how data is being governed in systems that do not respect borders, and how inclusion is being expanded through mobile money rails, and how regulators and institutions are managing the risk in the space that is ever evolving. And at this point, I would like to introduce our moderator, Ms. Rachel Kugonza, who works with ALN Uganda, which is also Max Advocates in the banking and finance practice. Her work sits in the space where law meets transaction reality. Structured finance, syndicated lending, and cross-border deals involving lenders, DFIs, and corporates across the region. Rachel stands not just as a person who knows her way around the framework of finance, but one who knows how they behave when capital, risk, and regulation meet on ground. She's an advocate of the High Court of Uganda and a member of the Uganda Law Society and the East Africa Law Society. She holds a Bachelor's of Law degree from Makerere University and a postgraduate diploma in legal practice from the Law Development Center in Kampala. Rachel, you are welcome. The floor is all yours. You can now take us forward from here. You have exactly 2 hours and we're all yours. Thank you, Rachel, and welcome.
Thank you, Gabriel. It's such a pleasure to have you all here with us today. I will commence with our panel discussion. I have with me an esteemed panel, and I know that by the time we finish this panel discussion, we will have been enriched on various sectors and on various issues that we intend to discuss today on private capital and strategic investment in fintech, regulatory compliance, data protection issues, and risk governance, among others. So I'll proceed to introduce our esteemed panel. The first panelist is Sami Ndolo, and Sami is the managing partner of CDH, and he basically is in the corporate and commercial banking, financing and projects and competition practice areas. He's a leading specialist in finance and banking, restructuring and workouts, capital market transactions and mergers and acquisitions. He also, in the number of qualifications that he has, holds a Master's of Law in international corporate governance and financial regulation from the University of Warwick, a Bachelor's of Law degree from the University of Nairobi, and is also a member of the Law Society of Kenya and the International Bar Association. I welcome Sami to this discussion. I look forward to engaging with you. Our second panelist is Susan Barungi. She's the head legal and regulatory affairs at Airtel Mobile Commerce Uganda Limited. She's a seasoned legal and regulatory professional with over 19 years experience across banking, payments, and fintech regulation. She currently serves as head of legal and regulatory affairs at Airtel, like I mentioned, where she plays a key role in shaping a fair, inclusive, and innovation-friendly payments ecosystem. Susan holds a Bachelor of Laws degree from Makerere University, a postgraduate diploma in legal practice, and a compliance career certificate from the University of Cambridge Judge Business School, and is currently pursuing an MBA at the University of East London. Welcome, Susan, to our discussion. I'll also introduce Sami Nyaga. And Sami is an advocate of the High Court of Kenya and a fintech and financial services regulatory specialist. He serves as head of compliance at EGM Securities Limited, FX Pesa, a leading non-dealing online forex broker, where he oversees regulatory compliance and anti-money laundering frameworks, data protection, among others. He's also the principal of SN Nyaga and Company Advocates, which is a boutique law firm that's focused on fintech, capital markets, and financial services regulation across East Africa, and has advised players in various sectors, including payment service providers, forex brokers, asset managers, and the like. He has extensive hands-on experience in payment service provider licensing and structuring across multiple African jurisdictions. Welcome, Sami, to the discussion today. I'll also introduce Dorothy Dazi. Dorothy is a partner and head of telecommunications, media and technology department at Hilton Law Group, and the legal and regulatory compliance head at Green Telecom Limited. She's an experienced legal advisor specializing in data protection and privacy, TMT, fintech, labor law, among other aspects. Her deep understanding of legal and regulatory frameworks has made her trusted advisor to prominent organizations across various industries. She has also advised top organizations on data privacy, compliance, personal data, and has also drafted and negotiated contracts for technology providers and digital transformation products. She holds, she's a member of the Tanganyika Law Society, the East African Law Society, and the Tanzanian Women CEOs Roundtable. Welcome, Dorothy, to our discussion today. And last and definitely not least, Patricia Kamugisha, who's an associate partner at Kampala Associated Advocates. She practices in the banking and finance, commercial transactions, and corporate advisory departments of the firm, offering legal services to a range of its clients. Patricia has legal experience in banking and finance matters. She has advised several entities, including local commercial banks on securitization, structuring of facilities, perfection of securities, and providing legal opinions to banks on the legality, validity, and enforceability of securities that are provided by borrowers. She's also experienced in corporate advisory matters and has rendered legal advice to several clients in various sectors, including employment, climate financing, energy, among others. She holds a postgraduate diploma in legal practice and an LLB from Makerere University. She's a member of the Uganda Law Society and the East African Law Society. Welcome, Patricia, to our discussion. I hope that you can all hear me loud and clear. Okay, so we'll dive right into our session today. Our topic for discussion is banking on innovation, legal strategies for East Africa's fintech boom, and digital finance and a digital finance revolution. And today we will delve into all these areas into different thematic areas. Of course, our discussion probably will not be as detailed, considering the time that we have, but we will do our best to ensure that we share as much information as possible, and our experts share their experiences as well. So I'll start with Mr. Sami Dolo, and you'll allow me to call you Sami. So Sami, just from looking at latest research, the FSD, in partnership with the East African Venture Capital Association, Helicap, and FMO, published some findings some years ago in their sector study on investment opportunities in East Africa. And one of the results that they found is that Africa is the second fast growing region for fintech investments, with an 87% of compound annual growth rate. And in 27 alone, over 200 million USD was raised for fintech businesses in East Africa, with the majority of those funds going to Kenya. So I'd just like to ask, financial technology companies obviously are continuously on the search for funding, and PE funds and VC funds are some of the few financiers with flexible deal structures. How are PE and VC funds tailoring deals for fintech startups? And do you think that they are best suited to finance fintechs?
Yeah, thank you very much, Rachel. Honored to be here. Good afternoon, everyone, and hoping for us to have an engaging and interactive discussion. Yeah, I think, Rachel, as you've pointed out, I think the fintech landscape in East Africa is very dynamic, perhaps one of the most dynamic in the world. From mobile money platforms, to insure tech, lending, payment aggregators, and the like. So I think what we've managed to demonstrate in East Africa is that innovation does not have to wait for infrastructure. But that rapid rate of growth does not always result in durable enterprises. And so in as much as there's capital available for investment and growth and to spur that innovation, what really is needed is a convergence of that capital together with sound legal architecture, and also transactions that are strategically managed. So I think one of the things, as you're looking at how private equity and venture capital look at transactions, I think from the lens of legal advisor, I think one of the key things is just to realize that we have a patchwork of regulatory requirements, and so if you have a potential investee that operates excuse me, that operates in multiple jurisdictions across East Africa, I think one of the things that one has to navigate to facilitate that investment is what regulatory framework governs that group or that entity. In some cases, even within a particular market, you may have multiple layers of regulatory requirements, from insurance to banking and so on. And so you might find that unless you have a clear understanding of that entire framework, you're not able to structure the transaction adequately. Now, how we also approach this is to look at what stage is this the entity that is receiving capital, the fintech, the startup. At what stage is it? Is it early stage? Is it at seed stage or late stage? Because that understanding also informs the sort of structure that you come up with for the transaction. If it's early stage, the tendency then is to have convertible loan instruments. Increasingly, we are seeing the use of safes, the simple agreements for future equity. But one has to then figure out if you're using safe instruments, in as much as they're popular and so on, like in the US, are they enforceable from an East African law perspective? Are they, I think the reason they're so popular in Silicon Valley and similar places is that there's a lot of capital that is available, but you find that in the local market, capital may be more constrained, and therefore the possibility of that capital not being returned dissuades someone from using such an instrument. Again, is it late stage? So are you looking at equity subscription? Are you looking at share purchase agreements, shareholder agreements, and the like? Again, if it's later stage, then the due diligence is more, more intrusive and more detailed, just to make sure that the investment and the operations of that fintech then makes sense. Ultimately, we also look at things like the exit. We've had a lot of challenges as you structure the transaction. A lot of PE and VC clients will want to understand, right? So if I put in an investment either through convertible debt or through an equity subscription, how then do I exit from this entity in the future? Because it's not permanent capital. It's capital that needs to be returned at some point. And so, will it be a sale to someone else, another PE fund or VC? Will it be a listing on the exchange? Will it be a buyback of the shares? So all those things really drive, how then you structure your transaction. And there's no one size fits all. You really have to look at it from fintech to fintech.
And thank you so much for that. I think from what you've mentioned, it's important as a fintech to ensure that you are ready for that investment if it comes, whether early stage or late stage. And of course, definitely at exit, it's important for the PE fund to also assess, how they exit, like you mentioned. So just speaking to fintechs, and their need to grow and to develop, right, even from early stage, because many times we're looking at fintechs as startups, but they are already established fintechs as well. They are operating in a diverse and growing financial sector. So I just wanted to know from you how fintechs can leverage mergers, acquisitions to accelerate their growth and drive meaningful industry development, because they're looking to grow, and even with the funding, they want to expand, and that would mean either joining, having another PE fund acquire them, or the like. We've seen in the news that Moneypoint Incorporated, one of Africa's leading fintechs, has entered the Kenyan market with the acquisition of shares in Sumac Microfinance Bank. And then also sometime last year, we had that KCB had also acquired about 75% stake in Riverbank Solutions, which is also a financial technology firm. So just to hear from you, how can fintechs leverage mergers, acquisitions to accelerate their growth?
Yeah, certainly. I think it's known that organic growth is slow. It can be expensive and also uncertain, and that's why you find mergers or acquisitions being very attractive, because they also allow you to enter new markets quickly. and also acquire new capabilities, like licensing, maybe insurance distribution channels or networks, agents, and things like that. It also allows the consolidation of fragmented sectors. And so it's a path to scale and to scale quickly. But obviously, it comes with its own challenges, which one ought to be aware of. It changes the culture and the dynamic of the business, and that can have fundamental implications for the business. I think one of the things is, why do then an M&A partnership or a partnership transaction? What you have to look at then is are you looking to acquire shares? Are you looking to acquire assets? How then do you want to advance and scale? Are you acquiring a business as a going concern? I think you normally have to look at those because they have different implications in terms of regulatory approvals, tax efficiencies, how you're assuming liabilities, how you're taking up employees, if those are being transferred in some way. So as a fintech, one has to then consider, am I ready to actually acquire another business, or is it easier for me to enter into a partnership with them with a view to perhaps in the future undertaking an acquisition? Now, as for partnerships, I think they ought to be strategic. They can be in the form of joint ventures or licensing arrangements or distribution arrangements and the like. And so if you look at Riverbank, the one you mentioned, Riverbank being acquired by KCB, they were in a partnership for a long time, using the word partnership loosely, obviously, where Riverbank was providing technologies to KCB. And so over time, that developed, and KCB became quite reliant on that technology. And so to consolidate its operations, it made the acquisition. So you can see the transition that is possible from having a strategic partnership into an acquisition, and allowing then Riverbank's founders and the investors in Riverbank as a fintech to then find a way to exit the business. So I think ultimately, having either an acquisition or a strategic partnership can be quite a fundamental and important path to growth and scale. It also helps you, as a fintech, for example, you may not have licenses or similar authorizations that allow you to conduct certain businesses. But if you partner with someone else that has that license, you're then able to enter new markets and the like. So I think there are a lot of possibilities there, but what is it that you intend to achieve really drives then the approach you take and how you then implement it.
Okay, thank you for that. I think from what you've shared in our discussion is that there are many opportunities for fintechs to grow, either through getting capital from PE or VC funds, or even considering mergers and acquisitions as a source of alternative financing and growth. So thank you for that. We'll move on to our next panelist, who is Sami Nyaga. And we're really going to be speaking briefly on regulatory compliance and operational readiness for scaling. I just want to hear from you, Sami Nyaga. What are the licensing and regulatory compliance requirements that fintechs must be mindful of, especially those operating in multiple jurisdictions? Noting that, of course, the law varies across jurisdictions, and many times, by the nature of technology, technology is moving faster than the regulator. So I'd like to hear from you, Sami Nyaga.
Thank you so much, Rachel. Good afternoon for everyone who's joined. Thank you so much for joining us. As regards that question, I think Mr. Ndolo, Sami Ndolo, my namesake, has already touched on that in some sense. So I think that question is a bit broad, but it's a great question to introduce into this meeting. In my experience, when it comes to cross-border activities, essentially, it's the norm now. because the primary business model, I think, for most of those who are interested in these kinds of things is volumes, volumes, volumes. It's no longer targeting high net worth individuals unless you're doing fund management or things like that. So the larger your customer base, the better, and the more people you can offer your products to. I think my experience in payment service provision is that the more countries you can offer, the better a client you are to all the merchants who are willing to do business with you. And my reply to that question is essentially for each country and each entry, essentially the first thing to do is to ask yourself, whose toes am I going to be stepping on? So which sheriff, which regulator is going to be looking down your business records. And once you understand that, it's very easy to determine what laws to check. But in a general sense, really, the first one is the CBK, so the central bank of every country. Just check the regulations and their acts to see if any of the activities you're doing is a regulated activity. Then you can just go down the list. If it's a capital market based, I think capital market covers many fintechs. And then there's just the most obvious one. You might not be targeted by any regulatory activity based on the work that you're doing. So I think that the first thing is learn learn to check essentially the requirements for each geographical location you're going to enter, and then see if it's going to be cost effective to enter that market. A caveat that I want to add and that I need to explain whenever I'm dealing with this kind of transactions is that for each country that you want to become to want to do proper business in, like a proper regulated business in, you need a local entity. That local entity means that you need to set up a company there, you need to set up bank accounts there, you need to have a local director. And in that case, then you need to balance the cost of doing that against the cost of just getting a partner. When I say a partner, what I'm saying is you reach out to a partner who is a regulated entity that has a company, bank accounts there that you can just partner with. And if that's easier and more effective, then that is the way you should go. But essentially, what you're doing is you're offloading the cost of this. You're going to be paying essentially a subscription to this partner to be able to do your business there. So it's a question of whether you want short-term gains for a while or long-term costs that you'll incur now over a much longer period of time, because you're going to invest in a company in every single country that you want to operate in. And this is a requirement actually. I know there are people who do what essentially they play in the gray area. A lot of fintechs like to pretend that they're not regulated, but really they've just not been caught yet. They're going to get caught, especially with how serious all the regulators in East Africa are getting. It might not happen, and that's why people usually do this calculation to find out, hey, do I want to incur the cost of setting up a company, setting up the compliance team and the entire set, a local CEO, a local directors, local bank managers, and essentially they need to weigh this against the cost of the business they're going to generate. I'd like to give a few examples. So for forex brokers, they tend to the serious ones, they tend to enter the market properly. Currently, Kenya has, I think, up to eight or 10 forex brokers, and they're all properly regulated under the CMA. You can go to the CMA, you can check their website, you can find their offices. And it's not like HFM and Pepperstone and Scope, all these very large brokers are unwilling to play the gray market game. It's just that there's no cost value for it. Eventually, they won't be able to get payment systems. That's another thing that prevents a lot of people from doing gray market games where they're not regulated, they're not in country. You can't even collect money because a bank will ask you're collecting under what authority? And then they'll say, oh, you're doing Forex. Do you have a license from our local regulator? And that's the same, whether here in Kenya or in Tanzania, which is far more strict than Kenya, or Uganda, which is a bit less strict, but is still strict. It's very difficult to be able to do business if you're not properly regulated, which is why people go through partners. But for Forex brokers, it's nearly impossible to go through a partner. For payment service providers, you can kind of piggyback off some few programs, but many regulators are kind of stamping down on that as well. They don't really feel like you should be benefiting if you're essentially, the arguments for many regulators is that you're offloading risk to our country and you're taking revenue from us without even paying tax. So you'll eventually catch a foul of either the local regulator, the local tax regulator, which will obviously catch you eventually. The KRA has a period of 4 years before they catch anyone. It's like a standard these days. So my advice as it comes to essentially cross-border or operations in multiple jurisdictions, it's very good. The larger the base of customers, the better the business. But you need to balance that against the risk that you will not be able to do business ever again, and that you might become essentially grey listed. Many banks have learned that people are setting up companies, and once they've been caught, they throw them away. But now they're tracking the directors of those companies. And now they've learned that people are doing nominee agreements, that nominee directors can hide them. But that's no longer working because now, even here in Kenya, banks are asking for the UBO form indicating direct ownership. So I would advise that if you're going to enter a regulated market, which is the scope across all of East Africa, you need to be aware of what those regulations are. What is your business? Does it touch on, let's just start with the CBK. Does it touch on CBK? Does it touch on capital markets? Does it touch on insurance? Does it touch on any of these major pillars? If it does, you need to become regulated. You need to set up a company. Compliance with the law is expensive, but failing to comply to the law just means you won't make any money at all.
Yes, thank you for that. And definitely it's important to comply with the law. Just speaking of licensing, I just wanted you to speak briefly on virtual assets and what a fintech who's looking to enter the market in that space would be thinking when it comes to compliance and just looking at the licensing and regulatory requirements, noting that not every country has recognized virtual assets as yet officially, though they recognize that they exist. Yes.
So here in Kenya, for a very long time, essentially cryptocurrencies were banned. They weren't really banned. There's this famous CBK risk warning that was issued that everyone quoted, but essentially just said that if you buy cryptocurrencies, you're on your own. The CBK won't intervene. It wasn't really a ban, but the Kenyan government last year, in a bit of a shock, not a shock to everyone, but a shock, passed the VASP Act. So the VASP Act created essentially categories for operations. So let's say you're interested in tokenization. Tokenization is where you turn a real asset and then you make it, you correlate it, or you back it with a cryptocurrency, and you're interested in doing that. It's perfectly possible now. Tokenization is allowed under Kenyan law under the VASP Act. The only thing we're currently waiting for is the VASP regulations, which were issued earlier this year. I'd actually like to inform everyone that today is the last day for making public participation emails to the government so that you can have the VASP regulations changed to your suiting. So if you can send them, not even today, so it's by 10, so it's tomorrow. So you can send them by tomorrow, think EOD, that would be best. There's also a notice, maybe you guys can share it with them for where people can visit for the direct public participation. But essentially, the Act has created two regulators for VASPs, the virtual assets. So that's a CBK, which will manage issuers and people who are doing tokenization, and then the CMA, the Capital Markets Authority, which will manage people who are doing things like brokerages, exchanges, essentially everything that capital markets regulates now, like Nairobi Securities Exchange. There will be an equivalent exchange, but for crypto that will be managed by the CMA. People want to manage or receive crypto. People also want to do fund management for it. So there's so much available now, especially with the aggressiveness that people are pushing tokens. So I think what Kenya has done is really amazing. It's essentially created a system where we can properly manage the inflow of cryptocurrency. And one of the best things I've seen is that many people like the CBK leave you on your own, even when they regulate it. But the VASP Act has done an amazing job in protecting customers. It's made compliance much more stricter. One of the things that they've done is client segregation of funds. So that's a requirement under the CMA anyways, but now it's going to be under the VASP Act as well. So whatever tokens that you have under an exchange or the fund manager, they must be separated from any cryptocurrencies this fund manager holds. That means if the fund manager goes down, the cryptocurrency won't go down with them. That's something that happens with almost every other cryptocurrency I've seen. If it goes down, you're just told, hey, too bad. But now the CMA is doing what every other regulator should have done beforehand. No one is allowed to intermeddle with cryptocurrency. So the cryptocurrency will be treated the way we treat our funds here at FXPesa, a daily reconciliation. And I think that's going to be very good for customer satisfaction, for protecting client interests, and it will prevent the CMA from essentially working as a Ponzi scheme. Because many cryptocurrencies, they usually use as rug pulls, so pump and dumps, and that's what's going to prevent this from happening. This segregation of cryptocurrencies is going to be perfect for protecting customer interests. Um, Other than that, I think you can just take a look at it yourself. It's quite extensive. Um, and look and see essentially if you are doing any business related to cryptocurrency, now is really the time to see if you can become a regulated entity. It might be seen as a cost by a number of people, but personally I see it as the best time because right now you can enter, especially in the Kenyan market, and given the Kenyan market usually leads East Africa, as a pioneer. And pioneers, just like Safaricom, like Airtel, they make, if they're good and they keep their products well, they make in the long run ridiculous amounts of money.
Yeah. Yeah, thank you for that. I think it's a great step forward, and I think other capital markets authorities across East Africa are opening up their minds to the possibilities, including virtual assets. I mean, here in Uganda, the Capital Markets Authority has a regulatory sandbox now for innovations in that space, and we're hoping that that will be an area as well that they'll be looking at. Our central bank as well is considering it, so who knows, maybe in a few months, a few years, that will also be the step that we'll be taking as Uganda. Thank you, Sami, for sharing. And just lastly, and maybe just a small comment on what you think fintechs that are looking to attract investors. What role do you think strong compliance readiness can play in investor confidence? How do early stage startups in the space demonstrate compliance readiness to investors, even though they've not really established themselves fully? If you could just give us a comment on that.
I think I can be very quick with that. So I've worked for essentially two startups, not truly startups. They were at least 1 or 2 years old, and they were fintech based. And one of the ways that they really showed to investors the value of their compliance system was their compliance with regulatory compliance. That's the most important one. An investor isn't just coming to buy your company, they're coming to buy your license because your license gives them the ability to do business into the future. And one of the most important things they usually check to see is, okay, have you been doing your proper filings? When they're checking your records or you're talking about it, they usually say, okay, have you been published by your regulator? And that's just like the basic one. The second one is they usually speak to your compliance team. That's if you have one, which is why it's very important you don't have a compliance team in quotes. You don't have a contractor or consultant who comes in maybe Mondays, Tuesdays, and then they're not really around most of the time. So I think the best way that fintechs can really show it is that they have, for those that are regulated, that they're in good standing with their regulator and that they have a compliance team on hand. The second one, for those ones that are not regulated, the ones that don't even really take it that seriously, is they can show it by showing that they have the basics, they have the policies, and the policies are at least been followed. I think the best way to show this is compliance with marketing. So even for non-regulated entities, the compliance team is usually the one that usually deals with the final determination on what goes out on marketing, and being able to show that your marketing is not being seen as spurious or as harmful to the market, as lies, or as giving too much promises to your client. That's a great way to show that you have an actual compliance team. Because if you don't have a proper compliance team, your marketing team will just run completely roughshod. They will meet their targets at any cost, something that I have learned. But it's not a bad thing. It's very good. They're the ones generating business, but it's also good that we also rein in because achieving those gains just so that we can eventually receive a letter by a regulator, whether we're regulated or not, is not really beneficial. I think the last thing to do really is papering. Does your company meet its board, does it board meet every quarter? And does it meet and then prepare resolutions that are actually affected? Does a board compliance team actually manage the company against the CEO? Usually early startups, the CEO is everything. They're the Lord and Commander. But having a proper board will give the what's it called? The investors really good comfort. They don't have to come and upend everything, establish a proper board. No, it has already been properly run. They're just replacing one director with another director. So I think that's essentially the final best way to show.
All right, thank you for that. I think, like you mentioned, it's important for any fintech to, in order to not only attract investment, like Sami Ndolo mentioned, just to also be ready for it. I mean, you want to be sure that you're confident on who is running things, that there's continuity of business. No one is going to close shop with customer funds and disappear. But like that investors are being protected, and considering also that fintechs serve a huge population of underserved communities. And as we move into our next discussion with Susan, Susan who works with Airtel, one of the visions for Airtel is serving underserved communities and promoting financial inclusion. So I'll invite you, Susan, to just, from your experience, what to advise us on what regulatory framework specifically govern mobile money and digital payment systems, because mobile money, fintechs that are involved in this space, of course, the telcos, are sitting at the intersection of finance, telecommunication, and technology, which makes them very unique entities because you have various regulators across the board. I'll invite you, Susan, to just give us your thoughts on that.
Thank you, Patricia, and good afternoon, everyone. I'm very happy to be part of this discussion. The regulatory framework and regulations that govern mobile money across the board. First of all, we have the global ones, we have the regional ones, and then we have the specific ones, especially in the space where I operate in Uganda. And at the global level, we have FATF, which really oversees and requires that KYC is done. Before that is know your customer. Before we have any relationship, we enter into any relationship with any customer, we are required to identify the customers and make sure that we understand them end to end. What do they do? What do they deal in? How much do they earn? etc. And also we're supposed to monitor transactions and understand where these transactions are coming from, the source, the purpose, and that's also part of the KYC. And where there is suspicion of the transactions or suspicion of the activities that are being conducted by the customer, we have a requirement to report to the Financial Intelligence Authority or the Central Bank of Uganda. So this one really sets rules to prevent money laundering and financial financing of terrorism. We also have the Bank for International Security Settlements, and this one does not mainly directly affect us, but through its Committee on Payments and Market Infrastructures, it issues principles for safe, effective, and payment systems. We have one where our Central Bank and Central Bank of Uganda and Central Bank of Kenya are part of, the Alliance for Financial Inclusion. And this one basically provides policy guidance for mobile money regulations in developing markets. We also have regulations for data protection and privacy, the European Union General Data Protection regulations, which impact even outside the European Union. We also have the regional, under the regional framework, under the East African Community, we have systems and frameworks for interoperability of transactions and systems, and also the African Union Digital Finance Initiatives, which supports harmonization of cross-border payments and fintech regulations. Now, specific to Uganda, in Uganda, mobile money is governed by, licensed and supervised by the Central Bank of Uganda, and the main law is National Payment Systems Act. This law was passed in 2020 and its regulations in 2021. Mainly, the law looks at licensing. You cannot transact any business in Uganda in mobile money without a proper license. It looks at, establishes certain requirements for example, trust accounts where money of the operations of the licensee cannot commingle with the trust funds. And when I'm talking about trust funds, I'm talking about the e-value that sits on your phone. The money that sits on your phone is not in Airtel, does not sit with us, but it sits in the bank. And there is a requirement for having trust banks and trust accounts with financial institutions where this money sits. And there is a daily reconciliation of these funds. And where the wallet falls dormant, we have a dormancy period, and where the money, the wallet falls dormant, we are required to remit the money to the central bank. We're also required to, under the national payment systems, pay interest on these trust accounts and trust funds. So on a quarterly basis, these trust accounts accrue pay interest, and this money is accrued on a daily basis. Actually, on a daily basis, the day you hold money on your wallet at midnight, it accrues interest, and that is the money that is compounded and on a quarterly basis is paid to customers. We're also required, which is unique, required to have a trust fund board to oversee the operations of these accounts, because the central bank is so concerned with the protection of consumers and customers' funds. And therefore, there is a board that is specific to overseeing and monitoring the operations and management of these accounts. We have definitely minimum capital requirements. We also have permissible activities and prohibited activities that we cannot carry out under this regime. And we also have reporting requirements under this regime. There are also regulations on consumer protection, that is National Payments Consumer Protection Regulations, and these basically translated what we had as mobile money. I think it was Mobile Money Consumer Protection Guidelines under Financial Institutions Act. So this was put into a regulation, and it makes sure that there is transparency in the way we communicate with our customers. We treat our customers fairly, and where there is a dispute or there is a complaint, an inquiry, it is handled timelessly. We also have regulations to manage agents. As you can know, some agents can be loose cannons, so therefore we have to track them. We have reports for these agents. And like you said rightly, the central bank also has regulations for sandbox. So if anyone is interested in innovating, and you are given an approval to operate within a sandbox environment and demonstrate to the central bank that the product you have is indeed a very good product. It is not being offered by anyone else. And so the central bank can give you an approval to come and demonstrate your product within a specific period of time. And if that product is indeed credible and the central bank is comfortable that everything ticks the box, then you can apply for a full license. We're also, and as people who handle money, we're also regulated under the anti-money laundering laws, the Act as amended and its regulations. And again, it reiterates the requirements under FATF for KYC, for reporting of suspicion, for transaction monitoring and all that. And we also have to abide by the Data Protection and Privacy Act, which provides for how we collect information, how we use information, how we store the information, require customer consent if we have to use the information beyond the purpose for which it is collected. So generally speaking, the regulatory framework we have in place for mobile money is that of licensing or approvals and authorizations, consumer protection, anti-money laundering, and CFT. safeguarding funds and cybersecurity, and making sure that the funds, customer funds, are secure, are safe, and we also maintain and keep the trust that customers put in us.
Thank you so much, Susan, for that. I think one of the important things that you've highlighted is consumer protection, and noting that Airtel, as one of the largest, telco companies here in Uganda, is serving, even the unbanked customers. So you'll find that someone deep in the village probably utilizes mobile money and has never opened a bank account. And so I just want to hear from you what innovative approaches Airtel has taken to increase financial inclusion for the underserved population.
Thank you, Rachel. So Airtel has taken a number of steps to make sure that we serve the underserved, because definitely we understand that there is a category of people that cannot even imagine entering a banking hall. And therefore, it's our responsibility to go to those customers and give them the confidence to use our services, and even in the comfort of their homes. So we have quite a number of innovations and strategic partnerships. And some of these, I can categorize them. For example, we have micro insurance, we have micro loans, we have the Global Pay Card, and I'll explain each one of them. So under micro insurance, we have what we call Hospital Center, and this is an insurance product where a person can pay as little as 5,000 shillings, and it's very common with our boda boda. Boda boda is motorcycle, riders. Very common with them that when you pay a very small amount of money into the insurance policy as a premium, then on the day that you get an accident and you're hospitalized, then Airtel can give you up to 100,000 shillings per day that you have missed work. So really, it's like a cashback for failing to do your work on that day. We also have what we call, so Hospital Center is definitely, we're not an insurance company, we don't have license, and it's also among the activities which are allowed with the approval of the central bank and in partnership with the service provider. So this one is in partnership with Prudential and Turaco. We also have Dwailo Care, which is also an insurance product in partnership with AAR and Blue Wave. We have a Sunset funeral cover with Stanbic Bank and Liberty, and then we have micro loans. So if you go to a supermarket and you get stuck, you're lacking 3,000 shillings or 5,000 shillings in your wallet, we will complete the transaction and give it to you as a loan, and that we call it a quick loan. So this enables our customers to get the loans in a very simplified manner. Otherwise, you would have to complete a lot of paperwork to get a loan from the bank. So we have the quick loan, we have Wewole. Wewole is a loan that you can apply to, and it goes into your wallet, while quick loan, the money goes actually to it checks out and the money goes to the service provider. We have agent loans, we have merchant loans, we have Kwasa Kwasa, those are all micro loans, which are small as 10,000 shillings, 20,000, up to 500,000 shillings. Some of them go up to 1 million, 2 million. And these are possible for our low income earners and people who are using a smartphone. You don't have to walk to the bank. We have also enabled now the customers to be able to pay for internationally for products with a credit card, which would be a credit card, only that this one is pre-funded MasterCard. So you get your MasterCard, you create your MasterCard in the comfort of your home, and you can pay for services and goods anywhere in the world. And this is something that would not be possible otherwise with the nature of our customers. We also have savings products. We have a super save in partnership with KCB, where you can save as little as 5,000 shillings, 1,000 shillings, and this also attracts an interest. Instead of putting money in on a savings account and it sits, we also give interest. We also have investment products now, where it was not possible for someone to buy treasury bills and treasury bonds through maybe a primary market or secondary market with the commercial banks. But now it is possible that you can actually, if you have, as long as you have a wallet, there is a product called Project Okusavinga. Basically means saving. It's with the central bank, so you can buy government securities using through Project Okusavinga using the mobile phone, and you don't need internet. You can do it through your USSD. So also the fact that you don't need internet to or a smartphone to actually transact, because you can transact, all these products, apart from the global pay card, you can get them with a feature phone. We have strategic partnerships and integrations with like World Food Program, for example, for people who are sending money to
Sorry, Susan, we seem not to be hearing you. I think there's a network issue.
Is that okay now? Can you hear me?
Yes, that's better.
Okay. So interoperability, bank to work, bank to wallet, wallet to bank. All those are products that we enable. Also, you can pay for utilities, you can pay for water, you can pay for electricity in the comfort of your home. You don't have to move, and it doesn't have to be a lot of money. You don't need internet. All these are actually done on a feature phone.
Okay.
There are so many innovations we have, and most of them are actually targeting the low income earners, people at the grassroots.
Yes, thank you, Susan, for that. It's exciting to see how many products are available, and not only to those who have access to the internet, but also people who are, using the feature phones like you mentioned. But in the process, and I will direct my comments to Dorothy. In the process, of course, Airtel has in its products, it has several partnerships with other entities. You mentioned KCB, Susan, and other entities to make sure that they are providing these services. But while that is happening, a lot of data is being transferred from across the board. So I just wanted to hear from Dorothy, given the volume and sensitivity of data that is processed and accessed by fintechs, like Susan was mentioning to us, because definitely they have different customers who are approaching them, and personal data in the process of providing that service is being collected. What governance structures and technical safeguards and internal controls really are essential to ensure ongoing compliance with data protection laws. And I'd just like to say, before Dorothy comes in to make her comments, we're happy to receive any questions or comments as we go on with the panel discussion. Don't be afraid to send through those questions, and we'll be happy to attend to them, either within our discussion or even after we've completed our discussions. So over to you, Dorothy.
Thank you very much, Rachel, and good afternoon, everyone. So basically, digital finance has significantly transformed how we transact, as Susan was saying. It has transformed how we save, how we access financial services, and at the core of it is a critical asset, and that is data that is being transferred from one point to the other. And particularly for fintechs, those who handle mobile money and digital payments, trust is everything. Trust is built on, I can say, three key pillars, and that is data governance, privacy, and cybersecurity. So when you're talking about the volume and sensitivities of financial data that is processed by fintechs, strong governance is not optional, it's essential. So from a governance perspective, institutions must establish, first of all, a clear framework that includes appointing data protection officers in privacy function. This is essential because they act as managers of compliance, making sure that the company is compliant with data protection and monitoring the fintech performance of large-scale transfer of information. Also, fintechs could have data governance committees. This could comprise of stakeholders from maybe IT, compliance, legal, business units, so as to define policies, data ownership, accountability. A fintech can create what we call cross-functional teams, like legal, IT, compliance. This will also avoid the business people having policies just in favor of the business, not in consideration of the compliance or not in consideration of the technical part of it. So this is a good strategy, but also third-party risk management. We need frameworks for vetting vendors, including security assessments, contractual rights to audit clauses that needs to be in the contracts, data breach notification requirements, and things like that. So if a fintech is integrating with maybe a foreign cloud provider, it must assess whether that provider meets data protection standards. It includes contractual safeguards. Also, there is data minimization and retention policies. These must clearly define policies to collect only necessary data and securely delete it when no longer required. Like this will avoid a lot of things because of issues if you put it clearly in the beginning in the policies. So a fintech will run smoothly. On the technical safeguards, fintechs should implement end-to-end encryptions. For instance, using AES 256 for data at rest and TLS 1.3 for data in transit to make intercepted data unreadable. Also to have multi-factor authentication, which should be mandatory for all users, administrators, API access to prevent unauthorized access, with preference for hardware keys or app-based codes over SMS. Also, on the technical part, the fintechs can utilize tokenization. This is replacing basically sensitive payment data such as card numbers with non-sensitive tokens, which will reduce the scope of PCI DSS compliance. So this replacement could be useful. And also real-time monitoring systems. These are also important. For instance, fraud detection systems flags for unusual transactions. So this is like real-time monitoring system that can be done by the fintechs. Also, zero trust security model, like trust no one, never trust, always verify. That works very well for fintechs, so as to restrict network access to reduce risk from especially inside threats. Also, regular security testing. For instance, banks and fintechs can conduct periodic penetration tests as part of compliance. And of course, this with central bank in Tanzania, it's one of the requirements. So this is also one of the very key things technically. But from an internal control perspective, the key measures could be role-based access control, like granting access to sensitive data, particularly only to a need-to-know basis. Like, does this person need to know this information? Yes, give access. No, access denied. So this will also limit internal insider risks. Also, audit trails and logging, maintaining detailed and editable logs of user logins, admin actions, and API calls to enable forensics in case of breach. In case of a data breach, what could cost a fintech is having no audit trail. So the fintechs needs to ensure that there are trails so that in case of audits, there is actually a trail that shows that audits were done. And incidents response plans, they're supposed to be made internally. This will include a documented, tested plan. It has to be tested to rapidly detect, to report, to mitigate breaches. And it should be compliant with for instance, for GDPR, it's a 72 hours notification rules. I'm sure for most of East African countries, it's much or less on the same timeline. And there should be also ongoing training to employees to recognize phishing, social engineering, safe handling of sensitive data. So trainings, for instance, to staff to identify phishing emails pretending to be from service like M-Pesa, for instance, because if staff are not trained, they might not know that this is a threat. So ongoing trainings are very important. So all these measures must align with applicable laws, such as for instance, in Tanzania, we have the Tanzania Personal Data Protection Act, which requires organizations to ensure security and confidentiality of personal data. And for our case here, the very last deadline extension was yesterday to ensure that all companies are registered, have registered the DPOs, and they are following the regulations and the rules and laws on the data protection. So, of course, ultimately, we'll have a strong governance and controls that are sustaining compliance and eventually build user confidence because there is trust which is maintained by fintech. So in summary, that's what I can say on that.
Yes. Thank you, Dorothy. It's important definitely to ensure that there is protection of personal data, and it's something that fintechs have to be mindful of. You mentioned when it comes to cybersecurity risks that you have as a fintech to have mechanisms in place to ensure that you have policies that can address such incidents, should there be a cyber attack and the like. So I wanted to find out what some of the cybersecurity risks are that fintechs face, especially those that provide mobile money services. And from your assessment, how the current legal framework across East Africa is ensuring that fintechs address cybersecurity risks, aside from the internal controls that you mentioned.
All right, thank you. So, of course, cybersecurity is a major concern, especially in all the East African countries. And when you're talking about we are having highly active mobile money ecosystem in East Africa, I can say. And common risks with local context are phishing and social engineering. For instance, fraudsters can send fake messages pretending to be from M-Pesa, Tigo Pesa, asking users to share pins. This is very common here in Tanzania. I'm not sure about the rest of the countries. Also, agent fraud, for instance. Agents mobile money agents manipulating transactions or exploiting customer trust in rural areas maybe. So you can have agent fraud. And of course, in our case here, you can find customer frauds, as in a person can do a transaction and then reverse it after getting the money, they can reverse the transaction as almost immediately. So that has been an issue here. And then you can have SIM swap frauds. For instance, criminals can hijack a customer's phone number to access their mobile wallets. This has happened a lot. And in our case here, they go even further. They go to contact your contact list, ask them to send them money. So a person hijacks you, gets money from your wallet, and goes further by pretending to be you, communicating with a number of people that you have saved, looking for money. And of course, those people will believe that that is you. They would not know that the number is being used by somebody else. So there are things like that. And then there's USSD vulnerabilities, for instance, interception risks during USSD-based transactions, which, for instance, in Tanzania, they are still very much used. And there is API vulnerabilities, for instance, weak integrations between fintech apps and banks exposing transaction data. So this is also a risk. And ransomware and data breaches, for instance, increased targeting of financial institutions due to the value of financial data. So these are some of the common risks in Tanzania, and maybe they could be common to the rest of the region. And regulatory response, we can say, like, we have increased enactment of data protection laws. We have Tanzania in 2022, Kenya was the first to have it, Uganda, and we have countries in East Africa that have at least a structured system of the data protection law that is in place. But also we have cybercrime laws. In Tanzania, for instance, there is a Cybercrime Act that regulates the cybersecurity. It's very independent on its own, and it has its regulations on how to do this. And of course, for the case of Tanzania, we have the Bank of Tanzania, the central bank. It has provided guidelines on ICT and electronic money. So these frameworks require fintechs to implement adequate security safeguards and report breaches. So there are several laws, and of course, they are cutting across from the.
Sorry, Dorothy, we have lost you.
Oh, you lost me.
Yes, you mentioned that there are several laws.
Yes, that cut across sectors from the technical part to cybersecurity to financial. So you can have laws guiding from different angles. Of course, there is no a particular specific law that covers everything. So it's a collection of different laws that guides the cybersecurity. And these frameworks, they require fintechs to implement adequate security safeguards and report breaches. So practical mitigations, of course, we've talked about that, and Susan, I think, spoke about it, strengthening KYC processes to reduce fraud, securing APIs and third-party integrations, continuous transaction monitoring, customer awareness campaigns of fraud prevention, and then incident response frameworks. But on the side of law, for Tanzania, we have Personal Data Protection Act, we have the Cybercrime Act, and then we have the Bank of Tanzania guidelines on ICT and electronic money that governs cybersecurity and aims at reducing the cybersecurity risks to the fintechs. And of course, it's not about compliance, it's about embedding data governance, privacy, and cyber security to the core of operations. So the laws are there to ensure that that is done. Thank you.
Thank you, Dorothy. Earlier in your submission, you mentioned that there are risk governance mechanisms that fintechs have to put in place, such as having incident response plans, and having and having mechanisms also when it comes to how they address data breaches, and also, such mechanisms like the zero trust security models and etc. So, and I think those are all important aspects. In fact, just looking at the fintech and financial institution space, they are indeed at risk of most of the cyber attacks that we see. And, regulators are now requiring fintechs to conduct third-party risk assessments, like you mentioned in your submission. Here in Uganda, the BOU has issued them in 2024, the Bank of Uganda Cyber and Technology Risk Management Guidelines, which really require supervised financial institutions to put in place mechanisms to to address cybersecurity incidents. So thank you. That was a really important thing to highlight. I'll move on to Patricia. And Patricia will be speaking to us really on risk governance, compliance, and digital and inclusive digital finance. Patricia, I just wanted to get your thought. When it comes to fintechs, when fintechs really operate as service providers to licensed financial institutions, because like we've heard from Susan, their partnerships with banks, how should both parties structure their third-party risk governance to ensure transparency, accountability, and auditability?
Thank you. So when banks get into arrangements with fintechs as service providers, they have to keep in mind that banks as financial institutions are highly regulated entities. So the arrangement between the bank and the fintech would sit squarely within the regulatory scrutiny of the Bank of Uganda. So in light of that, the banks and the fintechs have to make sure that their arrangement is in compliance with the law. The nature of services that are being contracted for would have to be taken into account. The bank would have to look into the fact whether this is a critical service, which would therefore need stronger risk governance measures. And if it's one of those non-critical aspects, maybe the risk governance may be lower, but it still has to be in place. And just to highlight, even while contracting these service providers, the bank needs to keep in mind that it's still liable or responsible for the actions of the service providers, and therefore the arrangement has to take that into account. In structuring the kind of arrangement between the service provider and the bank, it would be very good to have a watertight contract between the bank and the fintech. By watertight, it should be one that takes into account the obligations under the law. The contract should specify the services that have to be rendered by the service provider or the fintech, classify whether that is a material kind of service, is it critical, and based on that, have the risk governance approach taken into account. And then also, the agreement should take into consideration the risk and control standards. In that case, the contract has to keep in mind that there are certain measures that have to be put in place. Make sure that the fintechs have data protection embedded within their services, that they have consumer protection guidelines or something that guides them on how they are supposed to deal with these customers that they will be getting in contact with through the bank or the arrangement with the bank. The agreement also needs to take into consideration ensuring that the bank has supervisory and audit rights. It should be able to access the premises of the fintech, access the information, access the raw data if necessary, to make sure that they are keeping track of what the fintech is doing and how it is utilizing any information that is shared by the bank. The contract should also have the exit and continuity arrangement embedded in there. In the event that the services have to be terminated or suspended for a certain period, how is the bank covered in that space? What happens in the interim while an arrangement maybe is being put on hold? How is the bank able to continue providing the services even when the arrangement is being terminated? So the contract really has to take into account all those aspects and ensure it provides for them. Another important aspect is ensuring that on a board and management level, there is scrutiny from the bank and also scrutiny from the end of the fintech, because the fintech service provider should have its board in place. On the side of the bank, now the bank is going to be in charge of approving, first of all, the onboarding of the fintech. So the bank has to do its due diligence on this fintech, confirm that it's actually licensed under the Act, that it has all that it has to do is being done, it's complying with its obligations, it has the structures in place that have to be established, and then also the kind of products that it's providing, that they are in line with the law, and that they have the to ensure that data is being protected, that they are regulating how transactions are being done, monitoring any money laundering or terrorism financing, making sure that they don't fall foul of the law. On the end of the fintech service provider, they also need to have a board-approved framework, the risk framework. How are they going to handle any likely risks that arise in their arrangement between the bank? If they are dealing with customers, how do they deal with any complaints that are made? I have to make sure that they have all that in place. Data obligations, again, on the end of the fintech, it's important that they are registered with the Data Protection Office, they have their license in place so that that is catered for and there's no risk of having data leaks. Another critical thing would also be the cybersecurity aspect. In the arrangement between the bank and the fintech, that risk might arise because the bank is sharing information with this fintech, but you don't know the level of access that is given on the end of the fintech. Maybe their employees, or if they have agents, agent frameworks and networks, they have to be mindful of how that data is being protected. So once in a while, in this arrangement between the bank and the fintech, maybe they can have ethical hackers try to hack into the system or the service provision that is being done and check that are there any issues and make sure that they are plugged in time to make sure that this arrangement is safe and not exposing either party to any risk. Additionally, there is need for ongoing oversight, monitoring and reporting to make sure that everything is still going on right. There's need for the bank to continue monitoring. How is the fintech providing this service? Is it meeting its obligations? Is it dealing with customers' complaints in time? Is it providing information that is required by the customers and making sure that its systems are running and stable to ensure that the service is operating seamlessly? So continuous monitoring is very critical. There's also need for periodic reviews. Just do due diligence on this fintech from time to time to confirm that it's still operating in line with the law. Regulatory reporting is also something that has to be done by both parties. So they need to make sure that this is something that they are doing on a continuing basis. And if there is need for any escalations, the arrangement should also take that into account, establish the escalation protocols and make sure that these are being adhered to where necessary. So just to sum that up, in order for the fintech and the bank to build transparency, accountability, and auditability, it's important that the bank has visibility into how the fintech is operating, into its systems, its service levels, how it deals with incidents, complaints, just to ensure that it's able to get this information and see if there's any room for improvement, if any report needs to be made to the regulator in case there's been any breach, that is done in time. For accountability, it's important that the obligations of each party are clear, so the contract itself has to clearly stipulate what each party is supposed to do, and if any fails to fulfill its obligations, they are held accountable. For the auditability, the main emphasis here would be on maintaining logs, having evidence or controlling how data is accessed so that there is ease in tracking. If there's been any breach, we know where it has actually emanated from. Yes.
Thank you, Patricia. From your submission, it is clear that both the financial institution and the fintech have obligations to each other, and ultimately, at no point in the course of that transaction or in that relationship, are customers affected negatively. So data should be protected at the financial institution level, and the fintech that is providing that service also has to make sure that there are protections in place to protect the consumers or the customers of that particular product. So thank you for that. It was important to note. And when it comes to a specific category of consumers or users, especially those that are the underserved, that Susan also mentioned. When we look at many fintechs objectives, it's really about financial inclusion, and that entity will, for example, want to reach various categories of people. And some of them may have limited credit histories, especially where, for example, the fintech is doing digital lending. And yet you'll see that many regulators have demands that you have to make sure you have strong risk management systems in place, and of course the bank and the fintech are complying. So I just wanted to find out from you how you think fintechs can effectively balance risk mitigation with their financial inclusion objectives. On the one hand, you want to reach everyone. On the other hand, someone in the village may not have, that financial history that you could use to bank on as you provide that service.
Okay. So yes, risk mitigation is a very important factor for fintechs, and they really emphasize this because if anything goes wrong, there can be quite a huge blowback. But how they can balance the risk mitigation with financial inclusion is actually provided for in the law, or at least they can make reference to what is provided for in the National Payment Systems Act. One thing that I can highlight is the sandbox framework. Now that allows a fintech to come up with an experimental kind of product that maybe could be geared towards meeting the needs of the underserved population. So under this framework, the fintechs could come up with that product and test it within there to see how it would work and whether it would be able to meet the need while still protecting them from any risks. They could also consider having tiered KYC because you're dealing with the underserved population. And the reason why most of these people are underserved is probably because they are illiterate. Maybe they don't know how to read, and most of these products are given out in English. And also, they could probably not have documentation that is required from them under more strict KYC requirements. So in order to make sure that the fintech is meeting its financial inclusion objectives, it could try to break the KYC down. When you're dealing with a certain set of people, maybe make them more simpler, but still make sure they're stringent enough to make sure that in the process of trying to broaden the reach of this kind of arrangement, you're not taking on risks that could later bite. So that's something that they could consider. The products that could be designed could be tailored to meet the needs of the different kind of entities. I heard Susan speak about the microloans that are extended. So depending on the nature of customers you're trying to target, you could tailor the products to meet their need, and that would help in financial inclusion. Also making sure that consumer protection is embedded within the kind of products that they are providing, because that's a very big factor. The underserved population, or those who are largely unbanked, it's because maybe they have a fear of the kind of services that are being provided by these fintechs. They wonder how safe their information could be if they share it, or how safe they could be from instances of maybe having malicious people get their information and reach out to them and somehow take advantage of them. So to allay that fear, fintechs should make sure that they have consumer protection embedded in their data protection as well, making sure that these forms, or the kind of information that is required of these customers, is clearly explained to them. If there are any adverts that are put out, make sure there are some in local languages so that people are able to understand the kind of services they are signing up for, and they sign up for them with knowledge. Also, just to make sure that if there are any adverts again put out there, they are not trying to missell a product. So you want to make sure that the information that you're giving about a product is accurate. So if someone understands it and appreciates it and feels the need for it, then they will sign up for it, and you'll have more of the unbanked take up these kind of services. As I emphasized, data protection also is a very critical factor. Yes, there's a huge risk while dealing even with the banked population, because we have hackers coming in and hacking into accounts. But now when you're dealing with the underbanked or the underserved kind of people, that risk could be even higher, because the money they are dealing with is probably their life savings. So you're not going to have a framework that is not making sure that their information is protected. So the kind of services provided by these fintechs that they're trying to extend to the underserved populations would need to make sure that they're in compliance with the data protection framework of Uganda, criminal enforcement, of course, making sure that there are no lines that are crossed. If they share their information, they need to protect it from malicious people accessing it and then reaching out to these people and making them lose trust. So I think it's about building trust and making sure that as you're trying to reach out to these people, emphasizing the kind of products that you're tailoring for them and making sure that they understand them. But again, keeping in mind the risks that could arise. Yes, you want to extend the products, you want to have more people uptake whatever you're providing them, but still have in place measures to make sure that you're mitigating the risks. Have your agents aware of what they're supposed to be looking out for, sending reports where need be so that there's someone always having oversight over what is happening in that kind of system and it's not abused. Yes.
Thank you, Patricia. I think from what you've mentioned, definitely the underserved community is a special category that needs special protection. And just even aspects that telcos these days have come up with, for example, just even your simple notification to not share your password with another party or not share your PIN with another party, and that notification is in English and in the local language as well, is just a demonstration that they are, risk mitigation mechanisms that the telcos are putting in place to make sure that even while they serve the underserved and ensure that the unbanked are brought on board, they are, mechanisms in place to ensure that personal data is protected, there are no cybersecurity incidents against them. And in that way, the fintech is not only, complying at a regulatory level, but is also ensuring that there's protection for those underserved. And I just wanted to hear from Susan, as someone in a huge fintech telco, which is serving the unbanked. What mechanisms has Airtel put in place to ensure that operational risk mitigation and fraud prevention, is put in place given the increased rate of fraud in mobile money transactions, and how we are making sure that the underserved are protected? Maybe you can just give us a comment in a few minutes.
Thank you, Rachel. Patricia has mentioned quite a number of them in terms of the contractual bit, the corporate governance, and I will not repeat what she has said, but just to say that we have an enterprise risk management framework which really stipulates a number of things and make sure that our systems and operations are robust. Risk registers, escalation matrices, the board that she has mentioned, penetration tests, all those are being done, and those ones I would not repeat. But specifically to fraud, there are technology-driven and multi-layered prevention mechanisms that we have put in place as Airtel to make sure that we, first of all, try to plug in and detect even this fraud before it happens. It's a very passionate thing with us and me personally, and I would like to announce to you, Rachel, that I have been nominated and appointed a chair of the technical committee of the Anti-Fraud Consortium. So I'm speaking from a point of passion.
Yeah, congratulations on that appointment.
Thank you. Yes, so we have what we call in place an IMSI. IMSI is International Mobile Subscriber Identity. And this is an identity on the SIM card that you hold. So we were terrorized by bank to wallet, wallet to bank, frauds, where people would go into an app or a system into their a bank account and pull money and send it into the different wallets, and this was happening after swapping a SIM card. They swap a SIM card and they do all whatever they wanted. So we implemented what we call an IMSI, and we give it to the the application free of charge to the banks, and they put it in their system. When someone swaps a SIM card on our side, they are notified, and so they put a cooling off period in place to make sure that there is no bank to wallet fraud as a result of a SIM swap. But also Airtel has, and I think it is the first spam alert system in place. It is AI generated. So within milliseconds, they are able to detect that you're about to receive a message which is fraudulent. So that message will come, but it will come with spam alert. So you will know that this message is intended to actually scam you. And so you're able not to react. We also have where you're transacting on an app and you're using Wi-Fi. We're not able to ascertain whether you're the one or not because you're not using our internet. So we have implemented a one-time password, OTP. It comes to your app, and then you're able to confirm that you're actually the one using it before you even putting the PIN. Then also the one magic bullet is definitely your PIN. Your PIN is supposed to be known by you. The problem we have is that we are oversharing. So you give it to the people in your house and you trust them, and these are the people who are actually defrauding us, unfortunately. Or also ADs. Some people are, assistants, etc. Some people call the agent and give them the number. So in that case, you can't know who has defrauded you. But with the use of a PIN, and if you keep it private, that PIN will actually protect you. We also have transaction monitoring strategies, and we have a system which is a 24/7. It has a number of triggers and rules. It has so many rules in place, right from new SIM cards and transaction amounts, transaction where they're coming from, numbers, etc. And that's why that you see that sometimes when you register a new SIM card and then immediately you put a lot of money, sometimes it gets blocked because it's outside the behavior. Sometimes it may not even be under the AML CFT, but because for us, we want to be sure that whatever you're doing is within. And this also extends to, for example, our super agents. If our super agent right now, if we put a rule and say all banks close by 7 p.m., why is someone transacting at midnight? So we're able to put that rule, and then we're able to monitor and trigger alerts where a transaction goes out of the normal behavior. We have cooling off periods for SIM swap. At the moment, it is 24 hours. So when you swap your card, you cannot immediately go ahead and transact mobile money. And the reason is because fraudsters were using that. They maybe they have your credentials, swap your SIM card and transact right away. We believe that within 24 hours, if your SIM card has been stolen, you're able to come to us and complain, and then we can support the customer. We also have transaction limits, and these are set by the government, the central bank. And then we have CRB checks for loans. So that's how we protect our partners, our loan partners. And also, some people borrow other people's funds and get loans. But we do CRB checks, and those CRB checks determine how much you can even get from a loan. Depending on your behavior, it also has a number of dependencies. And we will also acknowledge that there are some fraudsters that have been conducted, and then the money is terminated at agent points. But We do actually KYC verifications for agents before they start the business, and we do regular trainings like Patricia has mentioned, and also there are sanctions where there has been non-compliance. We can terminate, we can suspend an agent. And where a fraud has actually succeeded in a way, or almost succeeding, we also have mechanisms for addressing and supporting customers. A customer can approach us and we can, where there is either an error or it's been sent from fraudulently, we can reverse some transactions. We have the power to do that where it is possible, especially where the money has not been withdrawn from the other side. We can actually reverse where we confirm. I think it's Dorothy who said some customers can actually initiate the fraud. Some customers can be fraudulent and they seek to reverse the transaction. So we also have to make sure that it is not, the reversal is not fraudulent. Customers are able to get their statements on USSD and also on the app. We have transparency in fees and charges, 24-hour, 7 call centers, consumer awareness campaigns like Bera Smarty, and then where everything else has failed, then we also inform our customers that they have a right to escalate to the central bank for support.
Thank you very much, Susan. I think it's clear that as a huge telco, one of the largest, you are on top of your game, and there are numerous, not only fraud prevention, but also mitigation mechanisms that are put in place to ensure that at all times consumer interests are protected. And I think that's something that's a good thing, and hopefully other fintechs are taking note and will also ensure that such mechanisms are in place, not only because the law requires you to have them in place, but also because of the sensitivity of the operations that they're involved in. Colleagues, I hope that we have provided questions. I see that, Susan, you had already addressed a question from Marlene Vunia, where she was asking about one of the products you highlighted and asked if that product is only available to border riders and low-income earners, and your response is not really. It's open to all customers. So let's hope that there is no other criteria. Then another question from Philemon. He has asked, can a licensed payment service provider in Uganda operate in other East African member countries? I'll address that question to Sami Nyaga, and Susan, you can also make a contribution, or other members of the panel rather.
Hi, thank you so much. Philemon. So no, a licensed PSP in Uganda cannot operate in the other countries in Eastern Central Africa. This is largely because they're licensed under the Central Bank of Uganda. They're not licensed under the other regulated entities. So if they want to operate or provide funding in and out of other countries, they would need to become licensed in those countries as well. A good example would be, I think for here, Kenya would be Virtual Pay. There's also, I think, Centywise. They also, essentially, when you go to their websites, you can just go and check and see at the bottom, they usually indicate the countries where they process. And those countries, they also indicate they're licensed to process in those countries. So you usually see that they're licensed in Kenya, in Uganda, in Tanzania, in Rwanda. That's usually the standard makeup. So to answer your question, no, you can't. Like I mentioned earlier, you can do what's called as gray area activities, but essentially you eventually run afoul of a regulator that is far too strict, or far more strict than the usual. It's usually best to comply. So no, they can't operate. When I say gray area activities usually means partnering with a regulated entity here, so that a regulated entity essentially onboards you as a merchant, but you're doing aggregation. So this is it's a bit of a gray area, but essentially, if you go to the CBK Act under the National Payments Act for both Kenya, Uganda, Tanzania, I think yes, Rwanda as well, they all very specifically state that it is illegal and improper for anyone to do any payment service provision in their countries without a license first. So no.
Okay, thank you. I think the next question from Louis
Yes.
Chizito.
Sorry, Rachel.
Yes, Susan.
I entirely agree with Sami, and in our law, it actually provides that even if you get those licenses in those countries that you would like to operate in, the central bank actually has to approve you to operate in those countries as well.
Oh, okay.
Yes.
Yeah,
Yes,
I think
definitely.
maybe if I could add, I think one of the, I mean, I agree completely with what has been said. I think one of the at least positive steps that I've seen being taken is the Central Bank of Kenya and Rwanda having an MOU so that they have a license passporting framework that should make it much easier to recognize each other's licenses without undergoing a rigorous duplicative process. So I think over time, maybe that will expand and make it much easier to see that you get a license if you cross the borders.
If I could just speak on that, thank you so much, Sammy and Susan. Um, so what Susan said is it's particularly important. So here in Kenya, not just for PSPs or forex brokers, even just general intermediaries, if you want to become, let's say, a fund manager in Kenya and you're already a fund manager in Tanzania, what the CMA will do is they'll write to the fund manager in Tanzania and ask, what is the status of this person? I remember a time when I was working at the CMA and we were reviewing forex broker wanted to enter the market. We wrote to their regulators in Cyprus and in South Africa, and we learned that they were in arrears. What happened is we just told them, hey, go clear your books in your home countries, and then you can get a license here. So it's really important that if you're going to be doing what's usually called what's called passport licensing or trying to do passport licensing, you need to be in good standing with all of your other partners. Another thing what Sami said is really important, and it's going to become more and more prevalent is countries like Ghana, I think. Ghana usually essentially they give an easier time. They don't allow without a license in their countries for regulated activities, but they will give an easier time for regulated entities. Because what they'll do is what the CMA for Kenya did or the CBK for Kenya does, they'll write to the other home country and say, hey, what's their standing? Then they'll be like, okay, they're in good standing. Then they'll be essentially you'll be pushed onto the top of the list for the approval because they know this is a regular activity. There's an entity that knows how to deal with regulators. It's much easier to onboard them.
Thank you for your comment. I hope we have addressed Philemon's question. Sami Nyaga, I think the question from Louis Chizito is also yours, and he's asking whether ESM Securities operating an A book or B book. Is ESM Securities operating an A book or B book forex trading arrangement? And he also wants you to comment on the fact that ECN/STP forex market plumbing issue arrangements are not adequately disclosed to its customers.
Okay, let me deal with the first question. ECM Securities operating an A book or B book for forex trading arrangement. So I'm not entirely sure what that's asking exactly, if they could clarify. But I think essentially the first thing I'd like to ask, is it a regulated entity? And the easiest way, and I think this is something we should be doing, and the CMA is actually working on, is public outreach and training. So if you want to know if an entity is regulated, just go to the website for the country you're in, go to the regulator's website, and it will have a full list of all the regulated intermediaries for each category. So there's a forex broker. So just go to I'm not sure where Mr. Kizito is resident. So essentially. He's added something. I'm not sure which country he's actually resident in, so you can just go and check to see if they're regulated. And I'm not sure about the A book or B book for forex trading arrangements. Not too sure, but essentially, if they're regulated, they will be regulated for a particular category. So here in Kenya, for forex traders, there are non-dealing and then dealing and then money managers. So for FX Pesa is a non-dealing broker. So that means that we're straight through processing. That means a client sends instructions. We don't do anything with those instructions except push them to the MT4, MT5 website or platform, and they can trade. We just handle the money, which is of course client segregated, and we provide a liquidity provider so that they can have leverage, and that's it. Dealing can deal on their own behalf, on behalf of clients. It's a more risky business, so you can make money by essentially dealing on behalf of your clients and dealing on your own. And most businesses don't do that. Kenya only has one dealing, and then we have money managers, people who trade on behalf of clients. They're like fund managers, but they do only for the clients, and they do it on their behalf. They have to what's it called, limited power of attorney for each client. It's much more difficult to get that on because there's a question of dealing against your own clients. So I'm not too sure about the A book or B book. If you could just kindly explain that, or if one of my colleagues could assist.
Yeah, I think that's what. Okay, I mean, I'm not a trader or whatever, but I think that's the idea where A book you're the agency, but then for B book you're the market maker. So for as market maker, you're able to trade inside the system as opposed to the agency one where you're trading directly to the market and then giving the return back.
Okay, then I would need to do some investigations into. I think he meant EGM securities. Oh yeah, I understand completely now. Then essentially we're non-dealing. So we're not dealers in any way. We're just straight through processing. So straight through processing means that you open an account with us, you deposit funds, it goes to a client's agreed account. We give you access to the platform. It's just MT4, MT5, but through us. And then we give you leverage. So when I say leverage, I mean that usually most Kenyans, most Africans can't trade heavy lot sizes. So if you want to trade gold, you can't even afford to trade gold because I think the minimum is quite high. But here we give you leverage. The CMA here has very strict rules on how we're supposed to give leverage. And one of that is that we're supposed to give it to about 1:400. I think the top is 1:1200. And there's certain countries like Seychelles that offer it up to 1:2000. So this leverage is provided by a liquidity provider, and that is pretty much the entirety of our business. So no, we are not a B book for forex trading arrangements. Then ECN, STP, so also straight to processing forex market plumbing, are not adequately disclosed to its customers. I'm not sure what you mean, but we are very clear about the fact that we are only an STP. We are non-dealing. That means we do not give advice. We do not handle client funds. We do not handle client funds directly, and we do not at any time affect the business. So we can never take, like stockbrokers have to have insider trading rules or matchmaking rules to prevent them from doing market abuse. But us, we don't, those don't even apply to us because we're just straight through processing. Okay, in this edge, don't historians need to. Oh yes, I completely agree with this comment. I think Sammy has already mentioned that people are working towards and I think it's being worked on right now actively by the CBKs for both countries to have passport licensing. So essentially, I think the ELS is a perfect example of that. You're not exactly allowed to practice law just because you passed the bar here in Kenya, but it's much easier if you have a degree from Uganda to come to the Kenya School of Law and get the permission to practice here. So essentially, that's what they're working on when it comes to passport licensing. It'll be much easier if you're regulated in Rwanda, Uganda, or Tanzania to be able to operate in the wider East African region. And I think that's a large part of the East African community's unified business model, or the unified economy that we're working towards.
Yes, thank you so much for your submission. Unless the other panelists have something to add, I do agree with Louis's point. Yes, indeed. Oh, I see he has another comment, but yes, indeed, this regulatory model needs to be revised, and what Sami Nyaga and Sami Ndolo have mentioned is something that will be well received by the fintechs. Louis also says that he has been asking the CMA of Uganda to come up with forex dealing and non-dealing regulations. Why don't top law firms write to our regulators? Many youth are doing forex trading business and becoming rich. I don't know if the panelists have any comment on that, but maybe just to say that I think the CMA is more open-minded now as of last year. With the emergence of the regulatory sandbox, like I mentioned, I think they're being open to it because they acknowledge that indeed technology is moving faster than they are. And instead of running away from from the inevitable, it's time to, find out how we regulate such entities. So I can understand why they may be reluctant, but of course, the regulatory sandbox will help with such aspects. And I know that there are already fintechs that are interested and already, their applications are under review, at least as of yesterday when I inquired from the CMA. Unless any other panelist has a comment. We're running short of time. Maybe we could proceed to just give our parting shots. I'll ask Sami Ndolo to just give maybe a 1 minute comment, and then we'll move on until we finish all the panelists and we can close.
Sorry, Rachel. Sorry to
Yes,
interfere.
Dorothy.
There is a question, I think we can answer it. The agreement within a financial institution should include a section for dispute resolution. Which one is emphasized between litigation and ADR? I think we have overlooked it.
Oh, okay. Thank
Yes.
you.
So if I'm to try to answer the question briefly, there is no specific guidelines for which one between litigation and ADR should be placed. But ADR, especially arbitration, is preferred and emphasized mechanism because usually litigation is kept as a fallback or for specific situations. So he was asking between litigation and ADR which one should is supposed to be used. But for the nature of the financial agreements, looking at efficiency, cost, confidentiality, enforceability, I think ADR is the most preferred. And for Tanzania, for instance, the central bank prefers ADR. So before anything, the first thing the central bank will guide into ADR, which is faster and business friendly. So that was my response to that question. Thank you.
Okay. Thank you, Dorothy. In the interest of time, I'll ask Sami Ndolo to give his parting shots, and then we'll have Sami Nyaga, we'll have Susan, Dorothy, then Patricia.
Yeah, thank you. No, it's been very engaging. I've learned a lot. I think for me, it's fintech is still worth investing in, and we just need to make sure that we support the fintech companies themselves to get ready for investment, and also for local investors to participate in those investments. I think from where I sit and the sort of opportunities I see coming through the door from time to time, being investor ready is really fundamental, and it's easy to achieve, and you just need to engage the lawyers that are in the room. Thank you.
Thank you. Sami Nyaga?
This has been an excellent training. I've learned a lot, especially across the wider East African region. Especially the wealth of knowledge that Susan and Dorothy have brought, and Sami's insights into safe agreements, Miss Patricia's thorough explanation. But I think the most important thing is just to build capacity building here. One thing I think people mention a lot is that there's no college degree for compliance. That's why a lot of lawyers kind of just germinate here, because whenever any of us apply for any of these roles, we're just immediately approved for it, because there's really very few people who are trained in this, and I think that's a very big issue because compliance is so integral. Compliance with regulatory matters, compliance with board matters, compliance with internal matters. And I think from a personal perspective, a lot of people have been reaching out for registration of PSPs, registration of forex brokers, registration of fund managers, and they're mostly by foreign investors who are entering into the country. And then a lot of these foreign investors usually ask us, as Sami said, essentially, how can I just buy the license? Then you have to start explaining to them there's no buying a license. You have to essentially do an acquisition of a regulated entity. And that's when they start looking under the hood and they're like, this company is into all the trouble. So yes, being prepared for the acquisitions that will come in is very important. And just having a ready and capable legal team and compliance team is so important, because it's all smooth sailing. It's inexpensive. You won't find if you don't have a compliance team, it's so easy to just run things because you don't have this expense or these constraints until you get a letter from a regulator, and then it's far too late to do anything.
Thank you, Sami. Susan?
Thank you very much for this discussion. It's been insightful indeed, and I thank all the participants and the people who have logged in and for giving us your 2 hours to listen to us. For me, as part of the parting shot is people who have access to the people who have the powers, the taxation is too much on mobile money, and so it's becoming punitive and stopping the people who are supposed to be targeted for these services and products. And because of that, some people may shy away and taking us back to where we came from. But also, we have a problem of the central banks copying and pasting from commercial banks rules and regulations, which may not necessarily be very flexible. So I think we should allow for flexibility. We should allow for innovation to grow and have flexible policies so that we can continue to innovate and reach the underserved people. Thank you so much.
Thank you, Susan. Dorothy?
Thank you so much. It was indeed a very insightful discussion, and the panel was very engaging, and I've learned a lot. And in concluding, I think what I've came to realize with fintechs is that it is a very highly regulated, they're very highly regulated institutions. Like for the case here in Tanzania, I can say like they're the most regulated entities. From the central bank aspect, from the telco aspect, you have the TCRA regulating them. So being compliant should be like this whole should be the heart of the fintechs, because otherwise you get into trouble with so many authorities. But also, if you're compliant, it means that there will be smooth operation of your services, and it will be easy for everyone. And of course, we do agree that fintechs do really simplify life, especially in this digital economy. But for the case of my country, for instance, we're still very rigid, especially the central bank. So I hope going forward with more discussions and more learnings will be more lenient and more open. You can imagine Nala is a company by a Tanzanian, but it got licenses in all other countries. It only got licensed in Tanzania, I think last year, if not in 2024. That is how hard it is to get a PSP license in Tanzania and to have a mobile wallet or to have fintechs operating this. But of course, they have their reasons. They want to make sure that their finances and people's money are secure. But we hope that if we keep having these talks, things will change at some point. So we can't even speak about cryptocurrencies in my country at this point. Yeah, so we look forward to more developments with time. Thank you.
Thank you, Dorothy. Patricia?
Thank you. I agree. It's been a really insightful discussion. As my parting shots, I'll just say that as we see the fintech space grow and we have more entities getting this space, and also the banks providing this kind of service to its customers, I think the goal should be inclusive but responsible digital finance. As the banks are working with the fintechs, or the fintechs are working with the banks, they need to keep in mind that they are dealing in highly regulated sectors. So they have to make sure that they are complying with the obligations in there. They have their governance in check, and everything is in place to make sure that they are not caught on the wrong side of the law. And also with the enabling regulation that we have, that the regulator gives, they should be able to innovate, come up with other ideas, new ideas that are risk-based and proportionate, to make sure that they are able to meet the needs of various kinds of customers, so we can widen access without widening vulnerability.
Thank you, Patricia. Definitely hearing from the panelists, being investor ready is important, like Sami mentioned, ensuring that we have compliance mechanisms in place as fintechs, being responsive regulators to digital finance. And I like how Patricia has summed that up for us. Our dear attendees, our discussion today is by no means exhaustive. It's really just to open our eyes to the issues that are trending here in the fintech space, but also to offer some guidance and insights on how fintechs can grow and develop and how we can ensure that they reach even the underserved. So we've come to the end of our panel discussion or the end of our webinar. Thank you so much for making the time to join us today. We had at least at some point about 120 attendees, and I think that was a good number. Hopefully there were some regulators in the room to hear some of the feedback that was shared today, including the one that Susan shared. And we hope that as we progress, the ELS will, pass on our thoughts, pass on our recommendations to their various stakeholders, and we will see developments across East Africa to ensure that the fintech space grows. I'll hand over to Gabriel from ELS to conclude, but I've been Rachel Kugonza taking you through and moderating this panel. Thank you very much.
Thank you, Rachel, for that very excellent moderation. It's really been an insightful session. Thank you for your coordination. It's been quite amazing. To your esteemed panelists, Mr. Sami Nyaga, Mr. Sami Ndolo, Ms. Patricia Kamgisha, Ms. Dorothy Ndazi, and Ms. Susan Barunji would like to thank you from the East African Law Society for making time to be a part of this session and for always supporting our initiatives. We anticipate to have more and more and more of you, and hopefully we can have this discussion furthered in subsequent discussions that we'll be conducting throughout the close of the year. But we'd like to thank you all. Thank you for making time, dear participants. A recording of this session will be shared with you on your various email addresses, but you can also obtain the same by visiting our East Africa Law Society YouTube channel, which is East Africa Law Society. Now, friends, we have an AI masterclass coming up on the 7th and 8th of May. It will be happening in Nairobi, Kenya, at the Fairview Hotel, Upper Hill. So if you would like to attend that session, please do register or reach out to us at info@elosociety.org. Otherwise, from us, we'd like to thank you for being a great part of this session, and we look forward to hosting you in subsequent sessions. Thank you all, and see you next week. Goodbye.
Great. Thank you, Gabriel. And thank you to the panelists.
Thank you. Bye.
Bye-bye.
Thank you.
Thank you.